It's 2:00. Good afternoon once again to this Brenthurst Wealth Budget Seminar for 2020. And I would like to welcome everybody from Brenthurst, some guests, and especially those taxpayers who are going to be funding this budget of our new finance minister. My name is Magnus Heystek. I'm the investment strategist at Brenthurst Wealth, and we have on our panel today two experts with different fields of speciality. We have Elize Kruger, who's an independent economist, and she also does some work for us via Mike Sussler's business, economist.co.za. She'll be looking at the macroeconomic situation, the impact thereof. And then Gerhard van Graan, old friend from PKF. He's a senior partner at the auditing firm PKF. And might I say, he's been the auditor of Brenthurst from day one. So we've come a long way. I'd like to see what Gerhard has to say about the budget. But from me, I'm going to just firstly have a look at what some of the reactions were last night, bearing in mind it was a very, very busy news day, and we had, the Putin invading Ukraine, so the world's focus was not so much on South Africa as we would have liked, but on what is happening elsewhere in Europe and other parts of the world. But generally speaking, ladies and gentlemen, it was not a bad budget, considering, and I'll explain why, that the minister had money in the bank to play with. And one cannot underestimate the enormous positive impact the tax revenue overruns of approximately 182 billion rand had on this budget. So whatever your interpretation of this budget, bearing in mind, this is a vast difference to 2 years ago when government was effectively broke, not sure what revenues they would collect, and hence 2 years later we have 200 million plus in the bank as a result of the commodity super cycle. Gina Skuman from Citibank rated the budget 6.5 out of 10. Johan Els, always very positive about the SA economy, perhaps a little bit too positive, gave it a 9 out of 10. Ryk van Niekerk, old friend, colleague, editor at MoneyWeb, rated it 7 out of 10. Tabi Leoka, independent economist and a very good writer on economic affairs, 7 out of 10, and Gulam Balim, 8 out of 10. And go on. So generally, a budget that was well received by most people in South Africa. Of course, you had people who would find fault with it. We had the DA who said that the minister did not do enough on one side, and then on the other side, we had spokespeople from the EFF and from COSATU saying that the basic or the 350 rand for people in distress, and that it should have been doubled and quadrupled, and that we should have a permanent basic income grant very, very soon. But that's the nature of life in South Africa. You cannot keep everybody happy all the time. Now, this, ladies and gentlemen, is a background to the fact that South Africa is in the very fortunate position of having surplus cash, and it does impact on all the macroeconomic indicators that Elize will talk about. Go back 2 years in time. At the bottom, if you see that chart, the CRB commodity index, it absolutely plunged after generally drifting down for about 2 years, impacting on the rand in South Africa, our trade balance, etc. inflows. It collapsed. And April 2020, if you had asked any fund manager in South Africa, or the world for that matter, will you see a jump in the commodity cycle like we have on our screen, up 142%? Everybody would have said not a chance. But that is the nature of economic markets. And we just have an absolute explosion in the price of everything linked to commodities, hard commodities, soft commodities. And South Africa is in the fortunate position that we supply a lot of the hard commodities like chrome, iron ore, platinum group metals, and the money was just pouring into the country. It saved the rand, it strengthened the rand, saved our balance of payments. But the million-dollar question is this durable? Is this sustainable? Some people are saying it is not. And the danger is that this windfall is considered to be permanent which could create all kinds of problems down the line. I'm not going to spend too much time on some of the macro numbers. At least we'll be discussing these, but it's good news all around for the budget in the sense that what was extremely pressing 2 years ago, suddenly we have relief on the budget gap, the debt trap, etc. There are a trajectory of getting debt under control so that we can get it under control much faster as long as government sustains its fiscal responsibility. And there you can see how quickly things have changed, money flowing in faster than money is flowing out. So that's just some background to the budget, and it will also listen and that also enable the minister giving his first speech. But bearing in mind, he's been in charge. Mr. Enoch Godongwana is not new to the world of finance. He's in fact been the ANC's head of economic planning for the last 10 years. So he's very much informed and involved in the formulation of South Africa's economic policies. And there you can see a little bit of good news. Gerhard will talk about that. Corporate tax will be reduced to 27%, and there are some other good news numbers in the budget. But there are people warning, and Asan Mashanga, he's the economist of Alexander Forbes, one of our largest pension fund administrators in the country, warning that this is all good and well. We have money in the bank, but if the commodity cycle turns around as it does, or as it has in the past, we are in serious trouble, and that we must not fall into the trap and think that this commodity cycle will stay elevated as long as we would like it to be, and that could create problems all down the road very, very quickly. These are words of warning that needs to be heeded. So from me, I'm saying goodbye. I'll be handing you over to Elize Kruger. She will be discussing the macroeconomic impact of the budget. Will be followed immediately thereafter by Gerhard van Graan. But we will, you can start answering your questions or sending your questions, specific ones, general ones, and we will try and answer them after that. From me, until later, it's goodbye.
Good afternoon, ladies and gentlemen. Thank you very much for the opportunity to share with you my views on yesterday's budget. And thank you for the introduction, Magnus. I think you've already highlighted a few of the points. So I will not spend a lot of time on the main features of the budget, because I think most of you have read your newspaper this morning and you would have seen most of these. But it remains important background for the rest of my presentation, where I want to focus on a couple of important questions to really say, has this budget been so much different to the previous ones? And are we maybe not more or less in the same situation than we were previously? So the 182 billion in revenue overrun, yes, indeed, that has created the much needed space for the Minister of Finance, when he has had probably the most favorable environment for quite some time. If you compare that to the COVID period and so on, where we had to deal with a significant drop in revenue and a spike in expenditure at the same time. So the 182 billion was basically split into two avenues. 55% of the extra revenue was allocated to spending priorities, and 45% was used to reduce the budget deficit and also thus the borrowing requirement, which was, I would say, probably a good split. Yes, one would have always liked to see them pay debt off faster, maybe than this, but in an environment where we could not have had this at all, I think one should see this as a positive, that they did indeed use a part of this to bring down our deficit. Therefore, the overall numbers that Magnus also showed there, came out better than expected. Also, 5.2 billion in tax relief for the economy. I'll say a bit more about that. The drop in the corporate tax rate is positive. There was also quite a focus on enhancing employment opportunities in the economy. And that, I think, is also very much needed in our economy with a very high unemployment rate. The reiteration of the private sector's involvement. We've seen a bit of a golden thread coming through from SONA to the budget, which I also think is something to note as a positive, we can just hope that government will follow through on the intention that they now basically put on the table to have more private sector involvement in the economy. However, there's quite ambitious non-interest expenditure targets in the medium-term expenditure framework period. I'll say a bit more about that. You know, it looks very good on paper in terms of projections to see the budget deficit coming down to levels of around 4.2% in 3 years' time. But it does, one does need to look at the underlying assumptions, especially relating to expenditure items that is creating that favorable environment. And is that really realistic assumptions? We'll speak about that. The troubling state-owned enterprises is still an issue. Not a lot of attention was given to them, although a bit of a note to Eskom and so on. But let's talk about that. It's not, they have not disappeared. Actually, they have done very little in the past fiscal year to sort out their problems. The can kick down the road for grant restructuring. Yes, we'll talk about that. The basic income grant got a lot of media attention in the few weeks before the budget. But luckily, the Minister of Finance stuck to his guns, saying that we cannot have permanent new expenditure without permanent new revenue. A notable risk to the favorable consolidation framework has been noted. We must just take note of that. And then I would say the bigger picture, not so much different to a year ago, and I'll talk you through my thoughts about that. Then lastly, debt service costs. You know, we are still at a point where we take 20 cents of each rand of tax revenue to just pay the interest on debt. So that is very much a similar stat to what we looked at last year. So let's talk about a few critical questions to review the likely impact of the FY23 budget. So what was this budget's real impact on the broader economy and the well-being of South Africa? How sustainable is South Africa's fiscal framework really? And what is the impact on South African companies? What is the impact of South Africa's attractiveness as an investment destination? And then just a few comments on what is the status of the hot potato issues, being the basic income grant, our SOEs, and the public sector wage bill. And lastly, has the bigger picture really changed? So I think on the short term, yes, we have seen a good budget. But if we just, you know, take a bit of a bigger picture look, now, is it really so much better? Okay, so to answer the first question, the impact on the budget of the budget on the economy. Yes, I think some positives. As Magnus also pointed out, tax relief, I think, will definitely be seen as a positive for the economy. And I've included this table because it's actually very telling to see where the relief has come from, as opposed to just looking at the 5.2 top line number. So starting with indirect taxes, sort of toward the bottom of this table, the fuel levy have not been adjusted upwards. Now, you would have seen that it's the first time since 1990, so the first time in 32 years that we have not seen an increase in the fuel levy. Now, the fuel levy is typically a very good indirect tax because of the fact that everybody that drives a car will pay the fuel levy, whether you are registered for income tax, be it maybe a taxi driver that's not paying income tax, you will pay the fuel levy if you drive a vehicle. So it's a very good sort of broad net in general. So that's why government always like to increase the fuel levy, because that's easy money, and it also incorporates quite a wide part of the population. But having looked at what happened to the oil price overnight, when we've breached that $100 per barrel due to the geopolitical issues around Russia and Ukraine, and we are looking at a petrol and diesel price increase early in March in the order of about a R1.40 cent per litre minimum. So, I mean, talking about 20, we're soon going to talk about 21, 22, and still counting on the petrol price. So I think there was definitely some pressure on the minister not to hike the fuel levy. So if they did hike just in an inflation-related manner, it would have earned the fiscus at 3.5 billion. So that was saved. We are not paying that. Then on personal income tax, there was relief for bracket creep. Now that is the phenomenon that you will end up in a higher income tax bracket if you get a salary increase. So that income tax brackets were adjusted by 4.5% to accommodate an inflation-related rise in your wage. So if they did not adjust the brackets, government would have earned 13.5 billion. So if you add it together, you're looking at about 17, sorry, where am I now? 13.5 and 3.5, yeah, about 17 billion, which is basically back in the pockets of the households and the people of South Africa, which wouldn't have been the case. Then there was also an expansion of the employee tax incentive at 2.2 billion. Gerhard will talk a bit more about that, and also the corporate income tax. So yes, although government is seeing corporate income tax revenue to be neutral, given that there are changes to the framework of corporate taxation, it could still be for a company that does not have assessed losses, for instance, to have the benefit of that 1% reduction. So that's from the point of view of taxation. But then also for the very poor people of South Africa, it's been a good budget. So the extension for 12 months of the special relief of the stress relief grant, that is worth 44 billion. And also the average 5% increase in social grants, permanent social grants, is also worth about 24 billion. So if you look at all of these, one could rightly say it's been a good budget for South Africa. But then I want to say, what are the real indicators of well-being? And here we look at GDP per capita, and we look at the unemployment rate. And on those two measures that are actually, I would say, what you really feel in your pocket, we have done not so necessarily so well in this budget. So just first consider the real scenario on per capita GDP if we take constant prices. Now this graph will show you that in 2020 we had that significant drop, given that the economy contracted in real terms by 6.4%. And think about population growth of around about 1.4%. So we had that big drop in 2020. And now we are only slightly and gradually moving our way up again from that very low level. And with real GDP growth, as National Treasury is now expecting of only 1.8% for the next 3 years, you'll see that it will be incremental changes to our GDP per capita number if you look at those blue bars. And if you compare, for instance, 2013, that was our highest number, you can see that at this incremental level, i.e. economic growth too low to sustain the spending of this economy, we will only get back to that high level in, say, 2029. And if you just want to look at pre-COVID, and you consider the number or the level of 2019, you can see it will take us at least until 2026 to recover in terms of GDP per capita basis to levels of pre-COVID. So the 1.8% forecasted GDP growth rate for the next 3 years is realistic, I would say, but also way too low to address South Africa's social problems and to sort of put our fiscal scenario on a better footing. So you will still feel poor as a South African compared to any level, let's say, pre-COVID in the next few years, if you consider this graph. Also, if you look at the unemployment rate, so we've been hit hard in South Africa during the COVID year, and our unemployment rate at the moment is the highest of all that we've got data for, 34.9%. Currently, you can see on this graph, the countries, I think this is an emerging market comparison, but we are at the moment the highest in the world. And if you think about the budget and what has been said, one really wonders whether it will make a significant dent in this scenario that we currently look at. Yes, there were quite a few sort of mentions of the presidential employment scheme and, yes, the tax incentive, but will it really translate into a notable dent in this unemployment number, especially if you look at the youth unemployment side, that is at the moment at a staggering 66.5%. So then one really realized it's maybe not as easy to say, has it been a good budget for the well-being of South Africa? But the good noises were made, and we had the president, or a reference to the president's State of the Nation address. We talked about how the private sector must get in an enabling environment to create jobs, to grow, to make their profit so that they could employ more people. And we had also in the budget a fair amount of focus on the National Development Plan, Reconstruction and Economic Plan, some progress there. So they start to talk a bit more about that, but we need to see more implementation. You would also picked up on the public sector in infrastructure spending budget for the next 3 years that is stated at 813 billion. So, again, it sounds like good spending to come through, but we need to see the implementation. So from that point of view, if government really wants to help us in South Africa and it really wants to improve everybody's lives, now we need strong economic growth. We need growth way above 1.8%. And I think one must just remember that as a background. So how sustainable is South Africa's fiscal framework? Now, levels and ratios are looking a lot better. So yes, it was the revenue overrun on the one side, but it was also, if we compare like before November, or if we compare to February 21's budget, you'll recall that that was pre the adjustment to our GDP numbers. So subsequently, already in November at the medium-term budget policy statement, we've seen our ratios improved as a result of the bigger GDP numbers that was a result of Stats SA's 5-yearly exercise to look at the actual levels of activity in the economy. But be it as it may, we've seen a fairly good improvement in terms of the estimates for our GDP, gross debt to GDP ratio. You can see on the graph there, we're looking now at those red dotted lines, with debt stabilizing around about 75% of GDP, looking better than the numbers that we've seen earlier. And also on the consolidated budget deficit to GDP numbers, we are heading to better levels in 3 years' time. But if we look at the underlying assumptions to that, I want to just point your attention to sort of the history of South Africa since 29, where we have constantly been living above our means, i.e. we've been constantly have our non-interest expenditure running way ahead of our revenue. And this scenario was exacerbated in the COVID years. You can see that's a big spike upwards in expenditure in the same year where we had the revenue plummeted in FY21. Now government is forecasting a significant reduction in their non-interest expenditure, to the extent that they are forecasting that we might have a primary surplus in 3 years' time. Now, the main components of non-interest expenditure is indeed the compensation of the state employees, the wage bill, and also the social grants. That is making up the bulk of our non-interest expenditure. And to expect such a big drop would be, quite a big ask. And to just give you a couple of numbers to show you what I mean. So government is at this point in time budgeting for average nominal growth, i.e. before inflation, of only 1.8% in the compensation of state employees over the next 3 years. So if you apply a 4.5% average inflation rate, that would mean that the real compensation of state employees would drop by 2.7%. And in the overall, the whole scenario that they've predicted would then mean that consolidated real non-interest expenditure over the medium term would be zero. And this is really a big ask. And I'll talk a bit about that, but we've already slipped on the wage bill plans that we had last year, and already we've had inflation-related increases in the social grants. So to get to this type of picture of a primary surplus, it's going to be very hard for government to push through on the numbers that's put on paper. So from that point of view, I say the jury is still out. It looks good on paper, and to see a 4.2% in 3 years' time looks good on paper. But if we do not have a revenue overrun to the extent that we've been spoiled this year, it's going to be very difficult to attain that. And also, another way to look at it is to say, how does the spending components perform and grew over time? This is quite a telling graph. So the index is 100 here in FY14, And it shows you how the different spending categories have increased up until 21, and then what is projected in terms of the growth in the next while. So the one that stands out as like a sore finger is that red line, hey? Interest on state debt, interest and rent on land, but it's basically our interest bill to service our debt. You can see how that has significantly increased and is forecasted to be the fastest growing spending item in the South African expenditure framework. If you compare that to the households, the green line, you can see that tick up was basically the extra grant payments due to COVID. And thereafter, they expect the growth to be a bit more flat. Again, the jury is out on that one, where the government will actually succeed in stopping the special grant, but we'll talk about that. Compensation of employees, you can see there is also growing still stronger than goods and services. Goods and services being, the actual service delivery in the economy. And then you can see how capital assets have been the one category that did not get much allocation. It is actually now lower in terms of growth rate compared to where it was in FY14. So we're not spending money on infrastructure development and on improving our roads and the rest of it. We're spending most of our money on interest on state debt, social grants, and government employee wages. So last slide to just say how sustainable is this, to answer this question, is to look at stats on the numbers. So how many social grant recipients we had in FY22? That's an 18.4 million. Those are all the permanent social grants, be it child grants, old age grants, and so forth. Then you add to that the temporary recipients. That's another 10.5 that's receiving the special relief of the stress grant that was introduced in COVID time. So that brings you to the number of 29 million of a total population of around about 60 million that's receiving social grants at this point in time and will still be receiving in the next financial year. Now, we've heard that stat from the Minister of Finance yesterday, almost as a brag, that 46% of the population is now receiving social grants, but it's actually a dismal number, as we're supposed to have economic growth that would create jobs, that we can have less people on social grants. If you compare that to the number of registered income tax payers, now this number is the number that's registered, but not necessarily the number of people that's even paying tax. In 2020, the number of taxpayers that were assessed was only 5.2%, and it's even expected to be less in the last year. And then if you then look at the actual numbers in terms of number of taxpayers that's earning above 1 million, you can see it's but only about 333,000 of that 5.2 million are earning above $1 million, and we know that that's category of the income taxpayers are paying a disproportionate big part of overall personal income tax. So really, if you think about sustainability and you look at these numbers that say if you're generous, 5.2 million is paying the income tax for looking after 29 million. Or if you want to be even a bit more sort of bold about this, you can say that number is quite a bit lower in terms of the number of individuals that are paying to look after a big portion of the population. So not really what I would call sustainable. So not sustainable on, I would say, the composition of the budget expenditure items, and not sustainable on the number of people that are dependent on the state. So what is the impact on South Africa's companies? Just a quick slide on that, as I know that Gerhard will elaborate on the corporate tax, income tax cut. So yes, that is good news. But if you look at the broader economic growth environment, which I've already spoke about, the 1.8% for the next 3 years, one could equate that to still a very difficult operating environment for companies. 1.8% growth remains way too low for companies to really flourish in South Africa. But there were a couple of, I would say, sector-specific references, which I think are good. and maybe for specific sectors, there could be some additional sweetness in this budget. Excuse me. Low-income household expenditure likely to be supported by the higher social grants and the extended STR grants. So the likes of your ShopRite and Mr. Price and the low, the sort of low margin operators will most likely have further good prospects, given that household consumption expenditure for the low income side will hold up. Because that is true that your social grants are flowing through mostly in the form of spending on food, maybe transport a bit, and so on. So your low income households are, you know, very much surviving on the grants that they do get. Government fixed investment spending could potentially be an upside risk to the construction sector. You know, if plans can be executed, again, you know, I think over the whole budget, there's a word been written, implementation risk, and you know, a question mark. So if government could implement, and we could see estimated numbers like 813 billion flowing to infrastructure projects, and you know, the consecutive spending of that in the construction sector, it could be a job creator and it could be good for the construction sector. So just keep an eye on that. There's been a lot of detail about it in the budget documentation. And then energy-focused companies might get some benefit from the focus on energy security and the transition to a greener economy. So in the details, there might be some sectors that could have a better performance. Just one slide comparing South Africa's corporate tax rate at 27% to the globe. And you can see that we are almost more or less right in the middle if you do a very broad comparison. So it seems like to the left, 30% is a median number, and to the right, it's about 25%. And yes, one could argue that if government really wanted to make a big difference to the competitiveness of our companies, they should have cut by more than 1%. But I think the fact that they did follow through on the promise to cut the rate and that it's going to be effective soon is definitely a positive. And yes, I hope that that will also boost confidence among businesses, that there was actually a bit of a sweetener for them as well. Okay, to move on to the next question, what is the impact on South Africa's attractiveness as an investment destination? So I put up this comparison of the different sovereign credit ratings for our foreign currency debt. And you'll see the Fitch ratings, S&P Global ratings, and Moody's Investors Service, and how they've perceived South Africa's government debt and our ability to pay back our investors on those foreign currency debt. And, you know, I mean, we've had a lot of talk about this in the previous few years, especially up until the point where Moody's then also cut us to sub-investment grade 2 years ago. But you can see that for the moment, all ratings are flat. And I think, you know, this budget will probably be one where the ratings agencies will just sit on their hands and watch and see what's going to happen next. So already I saw an article that Fitch ratings was saying, you know, it sounds good on paper, but, you know, a couple of risks, and therefore we will just keep our ratings outlook unchanged. Though Fitch and S&P Global both have South Africa on a stable outlook, whereas Moody's, that's still one notch above. The other two have us on a negative outlook. So I would say after this budget, I would not expect a ratings agency assessment to be changed. I think that they will keep an eye, like we will do, on the implementation of the plans, and also on whether the risks and a couple of the very unrealistic forecasts really materialize. Then also, this is a graph that I've borrowed from Mike, where he always like to point out that South Africa is the only country in the world that's got a negative net foreign direct investment, net foreign direct investment stock. So instead of investing in our own country, South Africans take their money elsewhere. And, you know, then you look at factors such as lack of implementation. So we've got good plans, but we don't get the plans to fruition. Policy and political uncertainties. We constantly have that in South Africa, where we don't quite know what government will do next, be it on the mining charter, be it on land reform. Our BE requirements are considered to be an additional tax in South Africa. Corruption is still rife. Energy supply uncertainties, low business confidence levels, our mediocre economic growth outlook, and overall lower than average internal rate of returns in South Africa compared to the rest of the world, or compared to other emerging markets that are also competing for the foreign capital. So we've got quite a few things that we need to work on in South Africa to really become again an attractive investment destination. So I would say I would doubt whether this budget has really done that for us. Yes, a few here and there, a few snippets of positivity, a few right noises about private sector involvement, about fixed investment spending, but we're going to have to see a lot more serious implementation before we can say that the budget has got a very positive impact on our attractiveness as an investment destination. Now, I think I better start to move on quickly, and I'm almost through my presentation, but let's just quickly talk about a few hot potato issues. So maybe a lot has been said about the basic income grant. Maybe just 2 or 3 more points I want to make. The first is that I'm thankful that Minister of Finance sticks to his guns on this. And, you know, he said, the words I've quoted here, in the absence of high economic growth that supports long-term improvements in revenue collection, any proposal to fund permanent additions to public expenditure require careful scrutiny. So we can only hope that they will continue to be very careful in this regard. Because social grants currently, just to give you a number here, or the budget for FY23 is 248 billion, of which the temporary SRD grant is about 44 billion. And then the forecast for the next year, FY24, you can see is reduced to 212 billion, as government has not budgeted to extend this temporary grant again. But, you know, the jury is again out on whether they would be able to politically, and maybe right in ahead of the next election, say to the 10.5 million supporters, sorry guys, you know, we're no longer gonna pay you that. So that is still a big risk, I would say, to the projections currently in the medium-term framework. And then maybe just also quoted from the budget documentation yesterday, I think, to reiterate this point, they did put in this example to say that if you've got annual expenditure of around 50 billion, then you need to have either a 2 percentage point increase in all the marginal personal income tax rates, so that will mean everybody will be worse off, or a 2% increase in the VAT rate. So just to put it into perspective, so if we consider that, that will be a significant impact on all South Africans. Okay, and then next, just a quick word on distressed state-owned enterprises. So no surprise to learn that state-owned companies made limited progress in their reforms in the past fiscal year. A number of the state-owned companies have missed their capital investment and loan disbursement targets. So government say you need to do X, Y, Z before we're going to give you any form of further bailout, and they've just missed their targets, missed their, did not focus and did not get to that point. So we are still sitting with a number of state-owned enterprises with troubles. I've listed a couple of them that got attention during this budget. There's a 3-year allocation of about 77 billion that's in the budget for payments for financial assets, and it was set specifically for the recapitalization of Eskom and the Land Bank. I mean, that is quite a big number that we are looking at to spend on Eskom and the Land Bank. I mean, Land Bank's very small in this, but majority of that for Eskom in the next 3 years. So we are still looking at an unsizable, big contribution to the state-owned enterprises. Then I've just got a side comment there. So apart from what has been budgeted there for Eskom, there was no mention of other state-owned enterprises that's been budgeted for, or extra money allocated for the next 3 years in our medium-term framework period. But we've got a contingency reserve of 20 billion over the next 3 years. And then there's also a new line item that appeared that was named unallocated reserve. That was another 55 billion. So, there's a big question mark as to, what is that unallocated reserve for. So a contingency reserve is not typically if there's maybe something bad happening, be it drought or floods or COVID or something, your contingency reserve. But then, the question is why the big allocation for an unallocated reserve. So, it could be that there are plans to come up with some details that's not been shared in the budget at this point in time. Okay, so to answer the question, is it really, another one of our potatoes is the public wage bill. It's maybe just to say a few words about that as well. And again, this graph, which I borrowed from Mike, is showing that South Africa's compensation of government employees as percentage of GDP is still in the emerging market world, and actually developed economies as well included here, see Germany and United States and so forth, one of the almost about the highest. I mean, Namibia, just one of our neighbors, are quite a smaller economy. But if you look at all of these countries, we are one of the highest in the compensation of our government employees. So this is where the adjustment will have to be to get our fiscal scenario on a better footing. And just to say, government slipped already in FY22. So you'll recall this time last year, Tito Mboweni, then Minister of Finance, was quite harsh in saying, wage freeze, no increase for the public sector employees. But then, we ended up with additional cash payments to the employees worth about 20.5 billion that was not budgeted for. Thankfully for a revenue overrun. And then that amount, a similar amount, has now been added to the FY23 budget to also make provision that, it won't be a freeze. Now, for FY24, there's no budget change, so i.e., now there's the expectation then there will have to be a freeze of the wages in that year. And the question really is, how realistic is it to expect the public servants to have a zero increase? It's not been happening. Although it was good on paper last year, it's not been happening. So has the bigger picture changed? Now, to conclude with that question, and really, if you look at the overall story, our government interest payments as percentage of GDP, one of the highest among emerging markets. If you look at the trend between goods and services and debt service costs, actually, the bigger picture has not changed. There's less money for school books, medicine, accountants. It will hurt the private sector. It will hurt the BE companies. And yes, from FY23, actually, so this current new fiscal year, South Africa will pay more for our debt service costs compared to what we pay for goods and services. So that's not a good place to be. Looking at government debt to GDP levels, here we've moved a few places to the lower side positively after the numbers have been revised for us for the next for this year and the next 3 years. So that number previously was around about 75%. It's now 70%. So you can see we've moved a tiny bit, but we are still not a star performer in this regard. Actually, we know in South Africa that we are paying most of our income towards debt interest payments. So my last slide I've copied from Mike. Mike presented to this audience last year, and when I looked at his presentation, I thought, how spot on he was at this time last year. He said it's political suicide for the president to freeze civil servant wages, as the unions are his main supporters. And actually what happened in subsequent months is that extra 20.5 billion was paid to the civil servant wage bill. Then he also said it is political suicide for the ANC if the new uninsured unemployment grant is stopped. So what happened, the unemployment grant, that the SRD was actually extended by another 12 months with a price tag of 44 billion. So, if it sounds too good to be true on paper, one must just think about it. It is probably too good to be true to really get implemented. So in that regard, I think it was really spot on. And then, the numbers that you quoted there is very similar to what I showed you earlier, that actually the income taxpayers are looking after a growing proportion of the population, and that scenario is not sustainable. So really a confirmation that very little has really changed in this budget. If you look at the bigger picture, we remain structurally actually still at a scenario where we're not sustainable in our fiscal framework. So it is good for this year. It feels better. It's good to have tax relief. We see a bit more focus on private sector, but overall, I think we're still sitting in an unsustainable scenario. And if one of the risks would materialize, i.e., for instance, on the wage side, or on the social grant side, so we get that big grant to become permanent or so on, the whole picture will be upside down very quickly again. And that is my story. Thank you, Magnus.
Elize, before you run away, one last question. I started with quoting some of your fellow colleagues, giving a rating 9 out of 10 and 7 out of 10. I mean, considering what you just said, how would you rate the budget? What score would you give it out of 10?
Magnus, I would go with a 7 as well, because I think there's definitely some good noises in this budget. And there was also, the tax relief is very positive to me. The corporate tax cut is positive. Lots of talk about employment, incentive, private sector involvement. So the talk was good, and I hope that we can see the implementation. But, having looked at it a bit longer term, I do think we still have trouble, but I'll give this specific budget a 7 out of 10.
There you go. Elize, thank you very much. And now we say hi to Gerhard van Graan, who's going to be talking about taxes. Thank you, Gerhard.
Thank you, Magnus. Hello to everyone. Nice to be here. Let me just get the share going. There you go. Thank you. All right, so I would like to spend some time on the ETI. Elize has mentioned that there's been a nice increase in the incentive itself. I want to spend some time on the individual income tax regime of South Africa. Then specifically looking at SARS and improving the tax administration that supports this whole income collection of the state. And then the hot one, of course, is the 50 million rand asset disclosure as from 2023 onwards. Spend some time on that. And then if there's maybe 5 minutes, talk about some other items. So some positive news is that there's been a 50% increase in the which is substantial in the employment tax incentive. Now, if you employ unskilled labor and you pay a minimum wage, government will now contribute 1,500 rand towards that wage, previously 1,000. And that's for the first 12 months. And the second 12 months will be 750, which was previously 500. So that's a nice incentive for the economy. And it's obviously government's attempt to stimulate employment, reduce the unemployment rate. But one has to ask whether there's any value in this. It is an unskilled labor assessment, and it can actually be seen as part of the social services. Now, Elize has alluded to the fact that 46% of the population already receive grants and social income from government, and now we're adding more onto that plate. And if you add the government employees, which is another 2 million people, then that 46% is actually increasing to well above the 50% mark, which is an unsustainable setup for, I think, revenue collection in the future. Apart from that, we know that specialized companies are the ones that add value and that create employment for the economy. It's not government that actually generate employment. It comes from the people that run businesses and employ people to add value. So that on the employment tax incentive scheme. Then spending a bit of time on what has happened with the personal income tax for the individuals. If you consider that the current CPI in South Africa is in excess of 6% or roughly 6%, and the Minister of Finance giving us a 4.5% gap or break in terms of CPI, it means that we still have about 2% out of pocket. And there will definitely be bracket creep, like we have every year. Unless the minister starts to give us real CPI grants in terms of tax relief, everybody will continue to pay additional taxes. A very positive note, however, is the fact that work from home allowances will be reviewed and a work group will be established throughout this year. We feel it's a bit late, you know, COVID has come and gone to a certain extent. But yes, many people still working from home, and especially in the big corporate environment, it's always been difficult to claim for work from home allowances. So that's very positive. Then I'd like to drill down into a little bit more detail. Income up to 226,000 per annum is effectively taxed at 10% if you work out the tax on that. However, if you earn in addition to or in excess of 1.7 million, you effectively start off at a tax rate of 38%. And any additional rand earned is then taxed at 45%, which is incredibly high. It goes without saying that from a personal income tax perspective, we are one of the most highly taxed countries in the world. The question is then, where will growth for future treasury collections come from? We already know that the personal income tax, that's you and I, contribution is 37% of the total tax revenue collected by government. So 37% of all the taxes that are spent every year comes from the individual. VAT only contributes 27%, and we know that it's highly unlikely that government in future will increase the VAT rate from 15%, maybe higher. Unlikely, and we're looking at social issues there. And then the corporate income tax, it's only contributing 17%. And it's, of course, the working between the 45% personal income tax and corporate tax is sitting at 28% at the moment, 27% next year, plus a dividend tax. So, you know, corporate South Africa does not pay tax. They rather increase bonuses, increase salaries, and in that way collect their money. On top of that, we now have a lower tax rate of 27%. And compared to our trading partners who run between 23 and 24%, one would expect the Minister of Finance to, in future, consider lowering the tax rate on corporate income tax, which begs the question is that if more funds have to be collected, it will most probably come from the individual. And because the country is not growing at the 4, 5, 6% rates, it's very difficult to attract new taxpayers. We're actually running out of taxpayers. So just keep this in mind as we go through the next couple of slides. There are 15 million registered taxpayers in South Africa. And as Elize also mentioned, 8 million are not taxed because they're below the threshold. And of those 7 million that's left, less than 1% contributes to 29% of all income tax collected from individuals. That's 133 individuals that have paid 29% of all the income tax collected. If you then broaden the scope a little bit, 17% of the income taxpayers, the individuals, contribute 85% of all personal income tax revenue. So this just highlights that it's a very highly progressive tax system in South Africa. It means that few pay all the tax, a few people. And this is obviously unsustainable. It's something that government will have to look at. The question is, how do you how do you collect more at the growth rate of 2.1% projected for the next couple of years? There's no doubt that South Africa will have to get into a high growth rate of at least 4 or 5% for the next couple of years, not only for 1 year, but on a sustained level. As far as corporate income tax is concerned, less than, well, it's far less than 1% of all companies that do pay tax contribute to 62% of the total tax collected from companies. That's a 770 number, 770 companies in South Africa that pay 62%. So again, total imbalance in terms of how it's collected and how it's managed by the tax revenue services. Right, so then the Minister of Finance also spoke about the focus on improving tax administration and rebuilding SARS, and we've seen some very positive notes there. 490 additional staff have been appointed. Some of them have been channeled into the high net worth unit, which was established last year. And it seems to be accomplishing their task. They have highlighted, and I think they've collected 550 million taxes in terms of taxes that would not have previously been collected if it was not for this investigative unit. And SARS has also continued to invest in the infrastructure, the software, computer technology, and we can see the result of that. If you run the business of interacting with SARS and you look at the trends, it's penalties all over. There's a penalty now for every contravention of compliance. Late submissions, no submissions, it's just, we haven't seen it at this level. And obviously this is contributing to better revenue for government. It is harsh, it results in a lot of administration from the taxpayer's side in terms of having to validate the fact that they may have been late, or there's no submission, or they being late. The trend is very aggressive from SARS. And then if we look at the impact that COVID has had on the ability of SARS and the revenue system to collect additional taxes, there's no doubt that working from home has created a significant pressure on SARS to actually deal with the administration. Meetings with SARS is now mostly done on a virtual basis like we have today. And just a general comment on that is that we're seeing about 1 out of 3 scheduled meetings taking place. The efficiency is very poor. It makes it very difficult to maintain compliance levels at this moment in time. VAT audits have escalated significantly to the extent that it's such a negative cycle that we see at the moment, where there are unresolved cases on VAT resolutions from SARS, which then means that the next VAT return is automatically audited again. And this escalates the cost for the business and for the taxpayer. So although we fully support improving the tax administration and rebuilding SARS, I just think the execution at this moment in time is not on par and is not as per promise. COVID has had a significant impact on the ability of SARS to manage that. Then the other hot potato that was launched or created was the asset disclosure of wealthy individuals. And the Minister of Finance then indicated that all wealthy individuals with assets above 50 million will have to submit their assets and liabilities as from this year onwards. So 2023 will be the first year, and the interesting fact is that he made specific mention of the fact that it has to be at market value. It's of specific importance to note the difference between market value and cost. If you consider that offshore investment allowances are based on cost and not market value, this is a very different approach that the Minister is now following. And one can only ask the question whether this is perhaps a new phase of wealth tax that is perhaps being pursued. Time will tell, but it definitely puts the focus on those that pay the taxes. Now, bear in mind that I've just said that less than 1% of the South African taxpayer population pay more than 26% of the personal income tax, which means that if one considers where they're moving with this wealthy individual strategy, that it will most probably lead to additional taxes, even further than what we have at the moment. But at the same time, we welcome the focus and the intent to broaden the tax base and identify any illicit wealth and stop the corruption in terms of asset accumulation. The one interesting thing that was absent from this presentation by the Minister, the budget speech this year, was that there was no mention of the spouse donation. And the spousal donation has to do with estate planning, and you get certain relief when there's death and it passes on to the next spouse. There was nothing mentioned. So the question is asked whether this is then held for the next budget release 2024. It's going to be interesting, but if we are going to continue to increase collections at the rate that is predicted by the Minister of Finance, then this is obviously one of the areas that they may look into. As a final note, and I haven't gone through any details, I don't think it's necessary, but some positive aspects from SARS is that when a company goes into business rescue, in the past, it's been very difficult for that company to obtain a tax clearance, a clean tax clearance, because obviously of the business rescue scenario. And SARS has indicated that, or the Minister of Finance has indicated that they will relook the procedure and try and assist those businesses. Also very positive for South Africa, and I think the COVID, vaccination being now in South Africa, being manufactured in South Africa, is also quite positive in that the research and development grant has been extended for companies for another year, and we hope that continues to remain. And then there's another interesting flow out from retirement funds in terms of the two-pot system, where government has indicated that they may actually allow employers to access their retirement funds even if they haven't resigned or taken retirement. And this is obviously to assist them with some COVID relief during this very difficult financial time that we've had with COVID. It hasn't been finalized. It's only happening now, but it's interesting, and one can have some views on it, whether it's good long term or not so good. Interesting developments taking place there. In terms of the areas that have remained untouched by the minister is the interest exemption, interest earned, no lifting of the bracket there. Retirement fund contributions have also remained at 27.5%, maximum 350,000. And then the withdrawals, also very highly taxed, that has remained the same. And just interesting to note quickly that on transfer duties up to R1 million value of a property, there's no transfer duty. And above 11 million, it's 13%. So it's interesting to see that these small little changes, 4 years ago, that 13% was sitting at 10%. Another 3% with ever increasing market values on property sales is also a nice revenue stream for the minister. That in a quick nutshell from my side. I'm open for any questions, should there be any. Thanks, Magnus.
Gerhard, thank you very much. Maybe while I've got you on the line, there's something as far as the retirement funding is concerned, and as clients of Brenthurst know, I've been pushing for this for a very, very long time, that the offshore allowance has been increased by, well, up to 45%, but it's only 35% in developed markets, excluding Africa. So effectively, quite a nice lift from 30 to 35% for retirement funds, retirement annuities, pension funds, provident funds. Still not enough in my view, but it's a welcome change. And I know that the investment industry has been pushing very hard for this, but I think the quid pro quo is that they'll have to be investing in the infrastructure schemes of government that's coming our way. So no doubt in my mind that there was some horse trading behind the scenes. We'll give you an extra 5% on the offshore side, but you've got to put some money into our project. So that's just the way these things happen. Gerhard, thank you very much on that. You want to comment on that?
Just one question. That obviously only goes for asset swaps. So it's not taken offshore completely. It's just a local investment being with an asset swap.
It will, but it will increase the returns because the returns have been very poor as a result of this restriction of only 30%. And
Correct,
most people don't actually know it because they don't do the numbers. But at Brenthurst, we've been warning people for a long time, get your money out if you can. The tax numbers and the small number of people who pay the large amounts of taxes is quite horrific. I mean, Elize touched on it, you touched on it, and you both used the words unsustainable. And one has to agree. I mean, the numbers are shrinking, taxpayers are fleeing the country, and they're just taxing more. So, yes, the windfall, and I come back to the points I made in the beginning, this is a windfall. This is not a permanent situation. And if or when the situation turns around, one can expect increased taxes on those who have the money, not so.
I think that's true. As Elize has mentioned, the paperwork on a projection is always very positive, and it looks it's always very promising. But if you have some hindsight and you look at the past history, it hasn't been that successful, and I think one can be cautious around those expectations.
There was a question that came through, and I think we can answer it very quickly. Someone said, did the minister mention anything about the national health insurance? And I didn't pick up anything on that. Gerhard, you didn't see it, or Elize?
No, I also haven't looked at that, but I think it was also a can sort of kick down the road for good reason, given that that's also a big chunk of expenditure, and there will have to be careful consideration before they embark on that.
I think we both have, all of us have used the word kicking the can down the road, and one doesn't want to be accused of being cynical, but we do have an ANC elective conference end of the year, and then 2 years later or the next year we have a general election, and this is going to put a lot of pressure on Treasury to start spending more. We have the civil servants issue. That's we know is a big issue. Shrinking tax base. So the warning that we are giving to our clients is enjoy it while you can, make best use of the tax incentives that you can, because this is not sustainable. Elize, I've got some more questions here. One for you, just a second. Derek, I'm not going to mention his name, but he's a respected tax practitioner, I believe. What could be expected to change spousal donations being exempt from tax? Gerhard, do you understand the question?
Yeah, what government has implied previously is that any donation from one spouse to the other upon death has been exempt. And what SARS is indicating is that there will be a limit to that going forward. So the 3.5 million could be maybe the limit, as is currently the practice where you have money flowing from the estate to other beneficiaries, and it will have dire consequences for estate planning. It can be very restrictive, but luckily, as I've mentioned, there was no mention of it again in this budget, and maybe they are considering that in future budgets, but nothing at this stage.
One last question that I want to, again, to you, Gerhard. I saw a notice in one of the commentaries by Glacier, the Sanlam company, saying that people who spend more than 183 days out of South Africa will not pay tax on their interest-earning investments in South Africa. Are you aware of that, or is that news to you? In other words, if you got 20 million rand in a bank account and you can live in Mauritius for 182 days, you won't pay tax on that interest. So that's an attractive tax.
I think there's a caveat there. What the Act actually states, unless there's some new developments which I'm not aware of, is that the first 1.2 million, if you're a South African tax citizen, you will be paying tax in South Africa on worldwide income. If you outside of South Africa by more than 283 days, or 183 days actually, then you will only pay tax on the income above the 1.2 million. And I have never seen exemption of any interest to that extent. So if you live outside South Africa and you're a South African citizen, you will be paying tax in South Africa on that income above the 1.2 million threshold.
That was my thinking when I read the report. I'll send it to you, but they're very clear. Interest earning investments. In other words, bank deposit, fixed deposit, and you're living outside of South Africa 182 days, you do not pay tax. Now,
please send it through. It's maybe a marketing
can
ploy.
Be indeed. Well, there was a question about Section 12J, but I think it was more a commentary. Someone wanted to say, government is forever talking about stimulating the economy, but during the last year, they closed down the Section 12J tax exemptions. Would you want to comment on that, Gerhard?
It is very unfortunate, but government has indicated over the last 2 years that it is most probably going to shut it down. There were 3 or 4 other incentives that have also been closed down, and I don't have the details here now. But yeah, 12J it's the last year of that, unfortunately.
Well, thank you very much, Elize Kruger, independent economist, copy DM. People want to write to you, they're very welcome. Gerhard van Graan from PKF, and from me, Magnus Heystek, on behalf of the Brenthurst team, we put this together. And to all our clients, if you've got specific questions, approach any of our investment advisors at our 9 offices countrywide, or you can write to me, invest@brenthurstwealth.co.za, and we will try and answer your questions. And to the team, Sue and Dalian, who've put together this webinar once again, I'd like to say thank you very much and a very good day to everybody. Cheerio.